Okay, we'll go ahead and get going here. I know there's a few that are going to be still joining class, but we'll let them go ahead and catch up with this. Again, thank you so much for spending some time with us this evening to talk a little bit about our home buyers class. This is the second installment we've provided for the alumni, and really excited to be able to partner with you and teach you a little bit about home buying, and which home buying may, for most of you, be one of the biggest financial decisions you're going to be making in the upcoming years. So really excited to be able to bring this content to you. In case you missed it earlier, we're going to have this class run just about an hour, so we should be done at the top of the hour. And we get a chance to teach classes like this all across the country, but really excited to be able to partner with the alumni to be able to bring this content to you. Just a little bit about me. I'm your presenter, of course, for this evening. And what I do is I help educate home buyers on home ownership. And oops, and are we having an issue with mute? Oh, hold on one second. Can you guys hear me okay? I think we're okay on the audio. Okay, I thought we might have been muted out, but can you guys let me just, if somebody can just let me know in the chat if audio is okay. Okay, awesome. Thank you for that, guys. I appreciate it. So a little bit about me. Of course, again, I'm your presenter, and I get a chance to teach classes like this all throughout the country. But I work one-on-one with clients, designing home buying plans for them and helping them on the path towards home ownership. So, not only are we helping educate you to start this kind of financial journey, but also, working with you one-on-one throughout the process. So for tonight's class, we're going to talk a little bit about the housing market in just a little bit. We're also going to take a look at interest rates and some of the movement we're seeing with interest rates. I do want to spend some time looking at a rent versus buying calculator. And this is kind of a great tool to help you kind of understand about budgeting for home ownership. We'll then talk a little bit about credit. We'll spend some time looking at student loans and how those can maybe impact your qualifying, look at loan programs, some of the documentation generally required for purchasing a home. We'll also spend some time looking at down payment assistance programs that are offered throughout the country. And then finally, I want to walk you through the workflow of buying a house. So after tonight's class, you may say, hey, I want to learn a little bit more about home ownership for me and maybe set some goals and objectives for home ownership. We're going to kind of walk you through what a personal consultation might look like for you. Okay, so that's our agenda for tonight's call, or class, I should say. Again, in case you missed it, I encourage you questions, because we'll answer some of those questions during the tonight's class. We'll also carve out a little bit of time at the end of tonight's class to review anything we missed, okay? All right, well, let's think a little bit about home owning. So, when you think about owning a house, right, it's probably, like I said earlier, it's going to be one of the biggest financial decisions you decide to make. There's also a lot of great benefits that come along with owning a home that we don't necessarily think about, because a lot of clients that I work with initially think about like doing an apples to apples comparison of renting versus buying. But I think we really got to consider all the great benefits that come along with owning a home. Like, we can control our affordability, because depending on where we buy and when we buy, that affordability changes, but it's in kind of more of our control versus, be subjected to the landlord increasing rents over time. The home should hopefully go up in value over time. As your home goes up in value, the difference between what you owe on your home versus what the house is worth, that difference is called home equity. There's also potential tax benefits that come along with owning a home that we want to factor into our calculation. And this is an asset that hopefully will create generational wealth over time. So those are things that we kind of want to think about when it comes to home ownership. And I think a great place to begin tonight's discussion is to look a little more closely at kind of a budget for home ownership, because our budgeting tool that I'm going to walk you guys through right now kind of takes into consideration all the factors of home ownership that can make a difference between being a renter for the next X amount of years to what it could look like with home ownership. As a side note, all of our material from tonight's class, we're going to share back out with you tomorrow. So all the presentation material, we're also recording tonight's class. So that'll all be available for you on our YouTube channel. And we'll also have all these tools like the calculator we're going to walk through tonight. Okay. All right. So let's, and we kind of, for timing purposes, we kind of pre-filled a little bit of this out for our class, but this is a rent versus buying calculator. And what we're going to do is we're going to simulate the difference between renting for the next 7 years versus what it could look like from an ownership perspective. So I know many of you are in different parts of the country for tonight's class. So some of these numbers may be closer for others, but I mean, ultimately, I want to kind of give you an understanding of like the baseline points to think about with homeownership versus renting. So In our calculator here, we have a $2,000 a month rental scenario here. We have monthly renter's insurance at $15 a month. And then we're going to forecast our rent potentially going up by about 5% on an annualized basis. So every time I renew my lease, that lease payment could go up by about 5% annually. And then comparing that to home ownership, in this scenario, we used a sales price of $425,000. We have a minimum down payment on a conventional loan, which is 3%. We're going to talk more about that in just a little bit, about, the different products that are available to you. We also want to factor in property taxes for our house. So depending on where we are in the country, those tax rates could look a little bit different. We have estimated homeowners insurance. We also factor in maintenance costs for our home. So those all go into kind of the expense side of things with home ownership. And then we have loan information. So for our loan information, we want to calculate this in at a 30-year fixed mortgage, because for the most part, our first-time buyers are going to elect a 30-year fixed mortgage product because it's fixed for 30 years, makes it much more predictable from a budgetary perspective. We plugged in an interest rate of 6.75%, but as you're going to learn a little bit more in just a bit, interest rates have changed a little bit since we built this out. We have origination charges, and those are closing costs that you're going to have as part of your home purchase. Now, one of the great things beyond our classes that we offer to our KU alum is that we're also going to discount our services to you by $750 for your closing costs in working with APM. So that's another great added benefit for you. And then I want to explain discount points. Discount points are when you as a buyer can elect to pay additional costs out of pocket to bring down your interest rate. Usually 1 point will be the equivalent of 1% of my loan amount. And usually that investment will bring down my interest rate about 0.25%. Now, in today's market, it doesn't necessarily make a lot of sense to make those investments because usually the recoup period or the return on investment is about 3 to 4 years when you pay discount points. But in all likelihood, for many of our buyers that are buying in today's housing market, they're probably going to be looking at refinancing their homes in the next 1 to 2, maybe 3 years. And so it doesn't necessarily make sense to make those kind of investments if we're going to turn around and kind of switch out to a different loan program or interest rate down the road or in the near term. We also have other settlement services that we're going to factor in, like attorney fees for the transaction, title and escrow fees, maybe some of the local county charges. All those get factored in. Then we have other assumptions about our new home. We're going to assume that our home could go up about 4% on an annualized basis in appreciation. I know that does vary based upon where you're at in the country. We also want to look at how long am I going to be in this house. So we're projecting out 7 years in the home. We have the selling cost of my house. So eventually when I sell the home in 7 years, how much am I going to pay in expenses for realtors that help me sell my home and maybe the realtor that brings the buyer to my house? We have state and federal tax rates that vary based upon where you're at in the country. And then, of course, we also want to kind of match that up against a savings rate, right? So when we look at our calculation here, we're first of all going to look at the payment difference, right? So renting, we're at $2,000 a month, going up on a 5% annualized basis. And then we have home ownership, which is $3,600 a month. So pretty big jump up when it comes to, what the monthly outgo will be. However, when we look at like the total cost opportunity over that 7-year span of time that I decide to own my home, it's about a $48,000 opportunity when I take into consideration my home appreciating over time and the potential tax benefits that come along with home ownership. So kind of to our point earlier, it's not necessarily that apples to apples comparison when we think about home ownership versus renting. So that's kind of the things that we kind of think through when it comes to looking at that comparison between what I'm currently doing in renting versus what it looks like in buying. All right, and again, that tool is going to be sent over to you guys. So we're going to have that calculator as part of our presentation material that we'll send to you tomorrow morning. Let's kind of shift gears a little bit. Let's talk a little bit about the housing market. We're going to look at the state of Kansas. I know not all of you are joining us from Kansas. I totally understand that. So these numbers will look different in different parts of the country. The kind of the trajectory of the housing market, though, even though the median price looks a little bit different, the trajectory doesn't look much different in other parts of the country. Right now, we're going through kind of the spring and summer season, which is generally the busier times of the year for buying. I think we still have a challenge that remains in today's market is we just don't have as many choices for our buyers. They're expecting inventory levels to be up about 10% year over year, which is super encouraging. We are at the same time seeing builders that are starting to kind of provide more supply to help, basically support some of the buyer demands out there. But, with kind of our economics 101, right? We have higher buyer demand, we have limited supply, that is going to push prices up. Especially, we're still in a very high interest rate environment. So it really remains to be seen what happens with our market. We're going to talk about interest rates in just a bit, and some of the I'll kind of give you a little bit of the forecast we have right now. But this housing market still remains to be in a pretty interesting position. You can see in the state of Kansas, we're seeing homes on the market about 22 days, which is still pretty strong. A lot of that reflective of what we're seeing in the inventory levels that are available. And then most recently, kind of a nice little uptick in prices in 2024, even in the kind of the headwinds of a higher interest rate environment. What does that environment look like? Well, here's a chart that kind of shows you guys the 30-year fixed mortgage rate over the course of the last 12 months. And we can ride a serious roller coaster ride here. We peaked in interest rates in October 21st to be exact, at 8%. And that was obviously last year. We've seen interest rates start to decline, but then they've been kind of on this bumpy road here. Average interest rate is probably setting around 7% currently. Last week we saw rates get into the 6.8 level, but then we've had some challenging economic data that's been coming out. Just yesterday, the the consumer confidence report was a little bit higher than expected. We also had some bond prices that aren't as favorable for the interest rate market. We have a lot of economic data coming out this week, including the GDP report, gross domestic product. We also have another inflationary gauge report. And really why we're here from an interest rate perspective is really the Federal Reserve trying to combat inflation, right? All of us feel it today, whether it's, going to the store and getting groceries and how much more expensive it is, to fueling up our car, to just overall cost of living, right? So things are more expensive, and to combat that, that's why we have this higher interest rate environment. Where do we go from here? I mean, there is speculation that the Federal Reserve may cut rates in September. And so that's what we're kind of hoping for, interest rates to start to come down a little bit. At the same time, that as interest rates start to drift lower, buyer demand does increase. And the question mark, I guess, if you will, is what happens with inventory levels. We got to somehow get more inventory on the market for buyers to have more choices, right? Because if that does not happen, then we could see prices push up even further. Now, as we look more closely at interest rates, not all interest rates are the same for all buyers. So I think that's something to keep in mind, because there's different eligibility requirements around interest rates as it relates to credit. The type of product you decide to select can impact your interest rate, how much you decide to finance, what your down payment is. I mentioned this a little earlier in our budget discussion, which is you can pay additional costs out of pocket to lower that interest rate. That's called discount points. So those are ways to influence your interest rate. And finally, the term of your loan can also change interest rates. So traditionally, we're going to look at a 30-year fixed mortgage, but if I condense that term down to a 20 or maybe a 15-year loan, that can also be an opportunity to lower my interest rates. Now, as we meet with our clients for a one-on-one consultation, we're going to figure out the product that makes the most sense for you and go through different interest rate options for you, because not every client looks at a 30-year fixed product or a 15-year fixed. Some clients want different options. And so we want to make sure you have all the different solutions that are available to you. And I think interest rate is kind of one of those hot topics, right? So if you talk to your coworker or a family member, they may say, I remember back in 2021, I got an interest rate of 2.5% or whatever the case may be. But I think it's important to understand, especially as prospective buyers, that interest rates will change daily. All markets are not the same. And I think the takeaway is not all buyers can achieve the same interest rate maybe that their neighbor or colleague was able to achieve. So all those things will be different factors that we want to take into consideration. Now, credit's probably the biggest impact item for us around different product solutions in home buying. So what we like to do in our classes is just to kind of give you a quick overview of what credit looks like from a mortgage perspective and give you some tips and resources to take away from tonight's class. Now, I think it's important to understand that there's a variety of different scorecards when it comes to credit scoring. Now, for those of you in tonight's class that use monitoring services like Credit Karma or some of the agency products through TransUnion, Equifax, or Experian, they have different scorecards that are accessible. But most are going to use the consumer credit card score. That's when you get your updates through your banking institution or through any type of monitoring service you have. So that score could look a little bit different than it might look like from a mortgage perspective. So let's take a look at what the weighting looks like from the mortgage score calculation. So off to the right here, if we kind of look at this score calculation, 15% is going to be how long have I had credit? So the longer my credit file is, the better my credit could potentially be. 20% is going to be how much credit am I trying to access? Am I trying to open up new accounts? Or am I trying to get new inquiries to access more credit? Those are called hard inquiries, and those could impact your score, especially in the most recent 6 months. Now, in our process here with our team here at American Pacific Mortgage, our process only starts with a soft credit check. And the reason why we do that is because most of our clients we're working with are going to be first-time buyers, and their timeline varies in when they're going to purchase. So we want to give them their product resources and options, but not impact the credit score. And so that's why we start with a soft credit check. And obviously, it's the hard inquiry hit to your score is 20% of your overall weighting. 30% is going to be around revolving credit and taking a look at your utilization of credit. So we're talking about your outstanding revolving balances versus your credit limits. So the ideal level is to have those balances be at 10% or less of the overall credit limit. So if I have a credit limit of $10,000 and I'm keeping that balance below $1,000, we're doing great. Now we're probably optimizing our credit score opportunity. Now, if I'm a little bit higher on the utilization, let's say I'm at 80% utilization, I really want to try to manage down my debt to get below 50% utilization. And that should give me a good lift in my score as I work closer to getting to 10% utilization. A lot of your monitoring services will say 30% utilization, but in reviewing different risk scorecards for the credit agencies, it seems that the movement really happens when we get to 10% or less. Let me give you a quick little tip on how to best manage utilization. So if you have some time, pull out one of your credit card statements. And when you look at that credit card statement, there's actually two key dates on that statement. One is the due date, which we all see, right? The other important date is the billing statement cycle date. And it's called different, different terms for different credit card agencies. But ultimately, the billing or statement date is the date at which the credit card issuer close out all your activity for that account, right? So all your charges, all your credits, any adjustments on returns or anything like that. So my tip for our class tonight would be if you can get in the habit of paying down your credit card before the end of the statement date or paying it off in full, then you're going to have a much more improved credit score because now you have a lower utilization level. Because what happens is if you pay off that credit card or pay it down on the due date, it's almost too late because now the credit card issuer has reported all the activity out to the agencies by that time. So kind of changing things up a little bit, try to pay those credit cards down before the end of the billing cycle. Last weighting in the credit card model is payment history. So that's pretty self-explanatory, right? How have I paid my bills? If I've had some past late challenges, they're going to be rated as 30-day lates, 60-day lates, and 90-day delinquencies. So the more severe on the late spectrum that event is, the bigger impact it's going to have on my credit score. Now, late payments in the last 12 to 24 months from the date of the event are going to have the biggest hit to your credit score. So if we've had a late payment in that time period, the further I get away from that event, the more kind of my score improves. So kind of organically goes up over time. Now, one of the factors in the score weighting is length of credit. And so I want to talk to you a little bit about closing out credit cards because many of us are always getting different offers to open up new credit cards. You may be tempted to close out another credit card. Just be careful before you do that because when you close out a credit card, what it does is it pulls away all the history you've had with that credit agency from the credit score calculation. So it can hurt you on that angle, but also it lowers your credit availability, right? Because now you have one less credit card available into the credit utilization component. So just be careful about closing out credit cards because it could negatively impact your score. Every loan program has a minimum credit score requirement. So we've put a few of those products on screen. You can see with the FHA conventional loans, some of our veterans products like the VA home loan and the USDA loans. So those all have various minimum credit score requirements. Now, from a lender perspective, here's how we look at credit scores. So there's three different agencies. There's TransUnion, there's Experian, and there's Equifax, right? So everyone has different scores because they have different risk calculations. Let's say my top score is 780, my middle score is 760, and my lowest score is 740. So from a qualifying perspective and to determine my interest rate, as a lender, I'm going to take the 760 credit score for qualifying purposes. Now, so that's the middle score of 760. If I have a partner that's going to join me in my financing, we're going to apply together, then we have to go off the lowest middle score between both borrowers. So if they're at a 720, 700, 680 score, the lowest middle score between both of us is a 700. So that is really important to understand because it can influence your interest rate, your product, how much down payment you need to make. It can also impact your mortgage insurance. So really important to understand that when it comes to qualifying for your financing. As we meet with you to go through your home buying plan, we're going to talk about, what that looks like for you. But I think it's important to understand when you apply jointly, it's always off the lowest middle credit score for both borrowers. Now, if we've had some past challenges, like let's say we've, had some delinquencies on something, maybe it's even a hard inquiry. So this matrix kind of shows you how long those events will stay with you on your credit report. Now, the immediate impact is going to be in the most recent 12 to 24 months from the date of the event. Now, there's a note here at the bottom. I just want to kind of make you aware of that. So if medical collections sometimes come up where basically it's a medical bill that hasn't been paid by a borrower, they put it into collections and it reports to the credit bureaus. Actually last year we were supposed to have medical collections not appearing on credit reports. You can see starting in early 2023. We still haven't seen that change take effect yet. But it's on the radar for the credit agencies to start removing medical collections from credit bureaus. All right, student loans come into the conversation in working with our clients across the country. And so, federal student loans are in repayment right now, as we all know, but there's different ways that you can repay, like an income-based repayment program, which tends to be the lowest qualifying amount. So a lot of our borrowers are utilizing that level of payment. So, for example, if we had a client that had $75,000 in student loan debt and they had an IBR payment of $250, that's what we're going to use from a qualifying perspective. So that's kind of the number we would use. Now, if that client does not have an income-based repayment amount, maybe they're in deferment or forbearance, then we still have to use a minimum payment when it comes to qualifying. For example, on a conventional loan, we need to count 1% of the aggregate balances. So that would be $750 per month. On an FHA loan, which is a federally insured loan, it would be half of that amount. It would be $375 or 0.5% of the outstanding balances. So that's kind of how we look at things from a student loan perspective. Again, if you're in forbearance for whatever reason, you're back in school and you have deferment, or you're just not making your student loan payments because you're not required to, we still have to, if you're looking to qualify for a mortgage, use a minimum payment from a qualifying perspective. Last thing I want to kind of touch on student loans, and we'll talk about loan programs, is that we do have some clients that are in public forgiveness for student loans, and that's totally fine. Usually that's a 10-year term. So once you've completed your time, then those student loans get wiped away. Even if you're in the middle of a public forgiveness program, we still have to count a minimum payment for qualifying. Now, of course, once we get to the end of that public forgiveness time period, then those items don't have to be counted against the qualifying. All right. Any questions on some of the content here so far? I know I've thrown a lot of concepts at you guys, but I want to make sure I get you all the right answer. So any questions from our audience so far? All right. Okay. As a reminder, you can drop your questions in the chat. You can use the Q&A function, whatever works best for you. Now let's talk a little bit about loan programs. And so we're going to spotlight 5 programs for tonight's class, give you a little bit of the characteristics of each one of those. And so I'll kind of walk through those now. The first is a conventional loan program. So when you think about conventional loans, those are Fannie Mae, Freddie Mac loans. They generally have a minimum down payment of 3% of the sales price, up to a maximum loan amount of $766,550. The minimum credit score for a conventional loan is 620. And the interest rate offerings on conventional loans will vary based upon credit score, down payment, like you heard earlier, and the amount financed. Conventional loans under Fannie Mae and Freddie Mac occupy about 70% of all originations across the country. So it's obviously a very popular product. A lot of the misconceptions around the conventional loan is that many people think they have to put 20% down to purchase a home using a Fannie Mae product, which is not the case. Especially as first-time buyers, you can put as little as 3% down to purchase. Okay, so that's the conventional product. And we're going to talk about mortgage insurance in just a bit as it relates to the conventional loan in just a few. Now, the FHA loan is a government insured loan. So FHA requires a minimum down payment of 3.5% of your purchase price. It's not just a first-time buyer product. It can be used by buyers who have bought multiple homes, but it does have that minimum down payment requirement, a little bit less restrictive from a credit score perspective because it's a minimum score of 580. FHA, as compared to conventional loans, will be a lot more flexible in terms of guidelines. So if I had a late payment on a credit card maybe a year ago, FHA would be okay with that versus a conventional loan. It might be a little bit more restrictive. So those are things that, may have a client look at FHA or over the conventional product. We're going to talk about FHA mortgage insurance because it is a government insured product in just a bit. And I'll show you what that comparison looks like as it relates to the conventional product. The VA home loan is for our veterans that have served and have eligibility in the VA home loan. It's a zero down payment option, so it allows the veteran to purchase up to whatever loan amount or sales price, I should say, with a zero down payment option. Now, the veterans do have a VA funding fee that's part of their financing. For any of our veterans that have any partial disability that are eligible for an exemption of that funding fee, that gets included into the VA funding or VA financing options as well too. But VA product is a wonderful option to help our veterans, and it is a lot more flexible from a qualifying perspective. The credit score minimums go down to 620 for that particular product. And then we have the USDA product. Those are for clients that want to purchase in more rural areas. There's kind of two qualifiers for the USDA product. It's location of the property, so it's going to be a little bit more remote, and it has income qualifying requirements. So based upon your household size, a client may or may not be able to be eligible for the USDA option. Now, the last program, which is not as popular with first-time buyers because it's going to be more for clients that are buying at the kind of higher end of the market, that's a jumbo loan product. It does require a higher down payment, usually 10 to 15% down. There's a couple other requirements with the jumbo product. It does have higher credit score requirements of usually about a 680 or higher, but the asset requirements are a little bit greater in that you need to save a little bit more for down payment. We have closing costs, which we'll talk about in just a second, but there's also reserve requirements with the jumbo loan, which generally requires you to have an additional 12 months of your total monthly payment in additional assets. So if I have $7,000 as my monthly mortgage payment, then I would need to have an additional $84,000 in assets that I could rely on, as part of my qualifying. All right, we had a question that popped in. I'm going to answer that real quick, and then we're going to talk a little bit about mortgage insurance. And the question is, for the down payment, if there's enough funds to put down 25%, how will this impact the loan? Is it better to just put 20% and use the additional funds to pay more towards a monthly payment if the difference between those two down payment percentages is not significant in terms of what is owed on the monthly? So, down payments or increasing your down payment, there's a few different benefits to it. One is obviously you're going to borrow less, so you're going to be paying less interest over time. And two is the less you borrow, the better equity position you have, 25%, could help you also influence a better interest rate option. So when we meet with you for a consultation to design a home buying plan for you, we're going to kind of figure out different numbers, what makes the most sense. So we'll plug in numbers at 20% down and 25% and see what makes the most sense for you. It may not pencil out for you to put that additional down payment, and maybe you could take that money and put it in a high yield savings account and get 4% interest and use that interest funds to put additional principal payments on your loan. There's a variety of different ways that we can look at that. But, we're always advocates of borrowing less if possible. But I think if you're trying to compare that to a lesser down payment, we would just want to make sure it makes sense for you. All right. Very good. Let's talk a little bit about mortgage insurance. And when we think about mortgage insurance, it has different effects for different loans. Now, with a conventional loan, when I put less than 20% down, I am going to have mortgage insurance. And PMI stands for private mortgage insurance. And there's mortgage insurance that's government insured. That's for the FHA side of things, which is our other side of the slide here. Now, there's different payment options for a conventional loan. You can pay it monthly. You can split the mortgage insurance and pay some of it upfront, some of it monthly. There's also single premium mortgage insurance where you can basically completely buy out the mortgage insurance. And there's also lender paid mortgage insurance. And that's where you elevate your interest rate to basically buy out the mortgage insurance in its entirety. Now, most of our clients are going to pay mortgage insurance as a monthly basis. So it's a monthly MI premium. And because the reason why most clients do that is because conventional mortgage insurance has a cancellation option. So when I reach 2 years in my loan and I have typically 20 to 22% equity, I can apply to have the mortgage insurance canceled. As opposed to FHA, which you're going to learn about in just a bit, does not have a cancellation option. Now, PMI is based upon, it's not one set premium. It's different for different clients. So it's based upon your credit score. It's going to be based upon your down payment and how much you decide to finance. So the higher I can get my credit score, the less I can finance, the more I can put down, the better my mortgage insurance is going to be. So if we looked at an example of financing, let's say $250,000, you had a credit score of 740 and you're putting down 3% for that home purchase, you're probably looking at mortgage insurance around $135 a month. Now, on the other side of things, the FHA product for the government insured option, it does have two mortgage insurance components to it. As monthly mortgage insurance, which is at a factor of 0.55% of my total loan amount. There's also upfront mortgage insurance, which is 1.75% of my loan amount. So there's two components to FHA mortgage insurance that we need to be aware of. And as I mentioned earlier, you can only exit the FHA mortgage insurance by refinancing out. So let's look at an option then to kind of compare the two. So with the FHA mortgage insurance, we finance the same amount of $250. The monthly PMI is slightly lower at $114.60, but then we also have to add in that upfront mortgage insurance, which is going to add $43.75 on top of my amount financed. So, I think when you kind of even things out a little bit, conventional is probably going to be a little bit overall less expensive. I think the question I get from a lot of clients is, why would I choose FHA or over conventional or conventional over FHA? Everybody's situation is a little bit different because the qualifying parameters will be different for the different products. And, when we meet with you for a home buying plan, we're going to figure out the right product match for you. But I think it's important for you as a first-time buyer to really understand the characteristics that go into each one of those loan products. Now, as we design home buying options for you, there is going to be some documentation required for the home buying plan. I wanted to provide you with kind of a checklist of what to expect. Generally we'll need the last 2 years of W-2s, last 30 to 60 days of pay stubs, usually proof of assets, bank statements, 401ks, 403b accounts if you plan on using those. Now, for our self-employed clients, it might look a little bit different because we're going to certainly need the last 2 years of filed tax returns. That's going to be a requirement for self-employed individuals. From an employment perspective, I want to give you a couple things just to think about. And these are really kind of questions that I get from our clients that we help. And that is the rule around a 2-year employment history. So a lot of people think they have to have 2 years on their job to be eligible for financing, which just really isn't the case. There is a 2-year rule, but the way the 2-year rule looks is that if I have job history and or educational history, I can meet the 2-year requirement. So for example, let's say I graduated from Kansas in the fall, right? And I just started my job January 1. If I have 4 years of undergrad and I just started my job in January, that would qualify for my 2-year requirement. Even in the case if I'm doing a job change, and sometimes we get that, especially when clients are in the middle of the home buying process. Let's say I'm getting ready to start a new job June 1, and I have previous work history, plus I want to use my new qualifying income starting June 1. We can certainly do that. We would just have to prove what that new pay rate is going to be with an offer letter. And then, of course, verify your previous or existing history. So, there's different ways that we look at that 2-year employment history requirement. Now, where it does get a little different is that if I have dual employment sources, sometimes we see this in the healthcare industry, where we have clients that are working at multiple locations for a healthcare provider. So let's say I'm working for 30 hours in one place, 20 hours at another. In that case, I do have to show that I've been working in both locations simultaneously for the last 2 years. The same thing holds true too for clients that are maybe working as a W-2 wage earner for their main job, but also are working a side job. Maybe they're working for Uber or Lyft, right? If we do want to include the Uber or Lyft income, we do have to show that both sources have been in place for the last 2 years, so that you've been driving for Uber and working on your job simultaneously for the last 2 years, just so you can we can show the underwriting team that you can do both jobs for the last consistency of 2 years. Sometimes that we have situations where we have partners that are contributing to the household, but are not exactly on the application. So if you do want to include, additional income sources from a partner that's contributing to the household, in most cases, that partner will have to be on the actual loan application in order for us to count that income. Sometimes we also have clients that are renting out a room, for example, and they've used that as part of their budget. It generally won't be able to be counted into most home financing scenarios. Okay. All right. And okay, cool. I just want to make sure we got that question answered. All right, awesome. So let's kind of shift gears a little bit. I want to talk now looking at just income versus expenses. There's a calculation that we use as lenders. It's called debt to income ratio. It's a really simple calculation, but I think it's important to understand as you're thinking about home ownership. It's going to compare your monthly income versus your monthly expenses that appear generally on your credit report. By the way, the income figure that we're taking is the gross figure, so your pre-tax figure versus expenses like your new housing budget. We're going to take into consideration your credit cards, personal loans, auto loans, student loans, anything like that. Those are going to be factored into your monthly debts. Here's what the calculation looks like. So principal and interest of my mortgage, the property taxes of my new house, homeowners insurance that I'm going to pay. If I have PMI because I'm putting less than 20% down, if I'm buying a condo, maybe a townhouse, I have a homeowners association expense probably. And then, so in this scenario, we have $2,500 in our housing budget. This particular client is paying $500 in other expenses, and then we make $8,500 a month. So we take those expenses of $3,000 divided by our $8,500 in income. Our debt to income ratio is 35%. So that tells us that our expenses with the new house payment occupy 35% of our pre-tax income. Now, the rule of thumb for qualifying is we generally don't want that number over 43 to 45%, but some of the guidelines will allow us to go as high as 50% if necessary. But that number is just a metric for qualifying. It's not necessarily an affordability metric. And that's a bigger conversation that we're going to have as part of a home buying plan for you, because we want to make sure that this plan that we designed for you is sustainable and most importantly affordable over time, so you can really obviously enjoy your home and not have to be stress free really of what that payment looks like. The question I do get quite often from our audience is, what should that debt to income ratio be for most first time buyers? The comfort zone, I would say, was probably be like 33 to 36% is kind of what I see working with my clients across the country. Now, the last thing I want to share with you as we kind of build our plan in tonight's class is savings for down payment, right? I think there's two things you got to consider when it comes to savings for home ownership. One is you're going to have to save up for your down payment, which we learned earlier at minimum is 3% of your sales price. Secondarily is we want to factor in closing costs to purchase our home. Okay, and closing costs can range as an estimate 2 to 3% of our purchase price. So that's what we should probably factor into savings. Now, there's ways that we have to document those assets. Usually we want to see the last 60 days of statements for a checking and savings account. If you're using a retirement, we can do that. I would always encourage clients, talk to your tax or financial advisor before you get into those assets, because we certainly don't want to create a tax complication for yourself. And then finally, gift funds can be used potentially, and that's where family members could help you out with the home purchase. I met with a client just a couple hours ago. They're contributing some of their own money, but their father is also helping them with some additional funds, and that's called gift funds. There is no seasoning requirement for that. There's just documentation that we have to provide if the family member is going to contribute to a home purchase. Now, assets or savings for a home purchase can be one of the bigger challenges to purchase a home, right? from my perspective in working with clients across the country, it's usually two things that can be kind of challenging. One is credit, because maybe we're a little overextended or we just got to pay down some debt, or it can be savings because we haven't saved up enough. So let me give you kind of a tip around a savings plan for you. And I know this may sound easier said than done, but if you were to kind of look at your own existing housing expense, and we'll use our budgeting tool, for example, if we're paying $2,000 a month in rent, but in my kind of goal for homeownership, I feel comfortable that I can get to $3,500 a month. So right now I have a $1,500 surplus in what my budget can look like versus what it currently is in renting, right? If you could get into the discipline or habit of saving like you're currently making a mortgage payment. So instead of, just taking that additional $1,500 that can go to homeownership, but redirecting that and putting that into your savings account, what that's going to do is allow you to create the discipline of paying $3,500 a month, but also accruing savings at $1,500 a month. And before you know it, after 6 months, now you're at what, $9,000 in savings. By the end of the year, you've saved up $18,000, which can make a huge difference when it comes to home ownership. It's just a little subtle change in how you budget yourself. But I would encourage you guys to kind of think more about that from a savings perspective. So trying to pay yourself into your savings account like you're currently making a mortgage payment. So that's just kind of a general idea, but that's one way you could think about kind of creating more savings for yourself. Now, beyond that, there are first-time homebuyer programs all across the country that can help you with home ownership. They're designed to help low to moderate income households. There's different what we call as HFAs. So those stand for housing finance agencies that can help you with home ownership. There are some nationally based programs too, and I kind of spotlighting one here, which is called the Freddie Mac Borrow Smart program. And you can get a grant of up to $500 to $1,500 in support depending on your level of income. And so it can make, the expense of homeownership a little bit more reasonable for you. But beyond that, there are local first-time buyer programs, usually at state level, that can help you with homeownership. If you're interested in some of the first-time buyer resources that are available to you, because I know we have our audiences in different parts of the country, get connected with me after tonight's class, and we can talk a little bit more about some of those resources that could help you on your path towards homeownership. Well, speaking of that path to homeownership, I want to kind of walk you through the buying process. This is called our 6 steps of home buying. And what this is, this process is the output of a consultation with us. So a consultation, which you're going to learn a little bit more in just a minute, it's a free service that we provide to you to build a home buying plan. The output of that consultation is to be pre-approved. And that basically means you have a product design all ready to go. You understand your goals and objectives for homeownership. And the pre-approval is a certificate that you can use to present in your offer to a seller. That pre-approval is usually good for 60 days, but it can always be recertified at any time, because especially for first-time home buyers, this isn't probably something that's going to happen in 60 days. It's probably going to take you 6 months, maybe even up to a year, maybe 2 years to find the home that works for you. So house hunting generally is the longest time frame, where you're actually looking online, you're looking in person, maybe with a realtor in your community that's helping you see different choices that are out there. Now, if you stumble across something that really checks all the boxes for you and your goals in homeownership, then you can work in partnership with a realtor, present an offer to a seller. Now, the seller will either accept that offer, maybe recommend some changes to the offer, called negotiating. But if that offer gets accepted, then you move to step 3, and that's called entering escrow. So that means a seller has accepted your offer. You're now starting the escrow time period. Usually that time period from acceptance to getting the keys to your house, it takes about 30 days. In some markets, it can be condensed as low as 14 days. So it just depends on where you're at. You will have action items that you'll need to do once your offer is accepted. One of the things from our team here, you're going to get a call from us to say, hey, congratulations. Let you kind of know a little bit more about what to expect, and then get a chance to get connected with you for what we call a follow-up consultation, just to go through all the design of your home financing so you understand everything that's going to take place and what's to come with the different milestones in the process. As a buyer, you generally need to contribute your earnest money deposit. It's called different things in different parts of the country, but as kind of a baseline, it's earnest money, which is usually 1% to 2% of your purchase price. There's some inspections that start as part of the process, and that kind of gets us going down the path of the escrow time period. Let me just let me just answer this quick question and we'll kind of continue on, which is if you do not buy a house in the 60-day time frame, does a hard credit pull happen each time? Great question. So that pre-approval is only based upon a soft credit check. So as long as everything kind of lines up for us with how your financing is set up and you meet all the qualifying parameters, we're only going to do a soft credit check for the pre-approval. We won't actually do a hard inquiry check until you have an accepted offer with a seller. All right, great question. I appreciate that one. Now, within the escrow time period, or the contract, I should say, there's a thing called the contingency period. So what contingencies are, and they mean different things in different parts of the country, but ultimately, it's kind of a time frame that you can do homework on the property, like get your house appraised to make sure your home is worth what you're paying for it. You'll get your house inspected, which a realtor will organize that. And then you'll get your loan approved with us, the lender, to make sure your financing is all taken care of, so there's no issues with that. Again, that happens usually in the first 14 to 17 days of your contract. That's important because it protects your deposit during the process. So if there's something that goes awry and it just doesn't match for you, and this isn't a good fit for you with this particular property, you can potentially cancel and get a full refund of your deposit. Now, continuing through the process, step 4 is the administrative functions of the loan, processing and the underwriting of the loan. We verify your assets, we verify your employment. We ultimately will probably have your interest rate locked in with your program by that time, because interest rates do change daily. So we don't want to have any volatility to your financing. As we move forward, step 5 is going to be the loan approval issuance. That usually happens in the first, probably week or so of the transaction. And then we kind of move along in that step 5, because then we get to a point where we're going to deliver to you a final closing disclosure. Gives you a 3-day cooling off period before we get to the final stages. By the way, in loan financing, you get electronic disclosures delivered to you throughout the process. So you get one set of disclosures within 72 hours of your acceptance of offer. You also get another set of disclosures once your interest rate is locked. And then finally at step 5, you get a final closing disclosure with everything kind of trued up on your loan. And that gives you a 3-day cooling off period to ensure everything kind of matches up for your financing design. Finally, step 5 brings you to the end of your contingency period. So if you feel comfortable with your homework that you've done on the property, then you can remove that contingency. That also tells the seller that you're ready to move to the final stages of the process. So what's that final stage look like? Well, it's the closing of the loan. That's the signing of your final documents. That one is done in person. Everything leading up to that is done electronically. You'll at that time also wire in your final funds for closing. Once those monies get reconciled, including the funds for your financing, then documents get recorded with the county recorder's office. They usually record what we call as a grant deed that transfers ownership to you. They also record a deed of trust, which is your agreement to repay the loan. Those documents get confirmed as recorded, and then I get a chance to make my favorite call of the day, which is the call to say, congratulations, you're now the official owner of your home. Time to get your keys from your realtor and start moving. And that's a huge celebration. It's a huge accomplishment. Again, best part of my day next to teaching, of course, our classes that we get a chance to do. But it's a big accomplishment because it doesn't obviously come with a lot of stress and anxiety through the process. But it's a big deal, right? It's going to be the biggest financial investment you decide to make in your upcoming future. Now, if you're thinking about maybe designing your own home buying plan, we'd love to be able to get connected with you. I've kind of mentioned that a few times tonight. And so that's a free consultation that we do with you, and allows you to have some goals and objectives for home ownership. So you don't have to be buying this year. It could be a next year goal, maybe even beyond. But we want to be a partner with you and kind of helping you understand what your options look like for home ownership. Now, maybe after hearing tonight's class, you just have some follow-up questions, like maybe a question on first-time home buyers ownership, or programs, I should say, or different credit scenarios you want me to kind of go through with you. We'd love to get connected with you for an introductory call. Again, we are a nationwide lender, so we can serve you in any market across the country. Here's what a free personal consultation looks like. So we're going to go do a lot of the same things that we've kind of talked about in tonight's class. This would only be a soft credit check as part of that, but it includes looking at your budget, where you want to buy, maybe some different first-time buyer programs that might be able to help you out, maybe giving you an idea of maybe how we can help improve in credit, and ultimately come out of that consultation with hopefully a pre-approval so you can start your home buying journey, or just overall just kind of a roadmap to home ownership. Now we have some great tools and resources that are available to you as well. This is our mobile app. So you can actually start the process all via mobile, available on Android and Apple devices. It also has really great calculator features that you can run different scenarios. So if you're on Zillow and you're like, hey, I want to see what this payment would be for me, you can do that all through the mobile calculator or the mobile tool. We're super proud of our Kansas University alumni partnership. This is a new partnership for this year. We also have other partnerships across the country. So if you have friends, family, maybe some coworkers that you think would really benefit from our educational platform here at American Pacific Mortgage, we'd love to have you get connected with us. Now, as a KU alum, you have your own devoted kind of landing page listing our upcoming schedule as well as your discounts that are available to you. You can find us there at kualumnimortgage.com. That has a list of all your services that we help support you with. You can also schedule your free consultation right there on that website. As we've been teaching classes over the last 8+ years, we have a lot of great testimonials from our clients that have graduated, so to speak, from classes just like this and have successfully achieved home ownership. We'd encourage you check out their stories on some of our Google reviews. I think that's really a testament of what we do. And I think some of our information we put on our social channels like Instagram, some of the YouTube videos that we put out are all there to help educate you as first-time home buyers. So you can follow us at JMeda Mortgage there. So that brings us to just shy of the top of the hour, but I want to make sure I can open it up for any questions that our group has. I try to answer some questions as we roll through tonight's content. Any questions that I can help answer for our group as we get wrapped up in tonight's class? Again, you can ask those questions by using the chat function or the Q&A function, whichever is best for you. Right, I think we did it. All right, no questions from our audience. Okay, I think, and just a reminder too, this class is being recorded tonight. So the recorded version will be up on our YouTube channel tomorrow. You'll also get all of our presentation material, including the budget calculator. I'd encourage you, if you have time, try to run your own calculation. I think that'd be super helpful for you. And I really do hope we get a chance to get connected with you to build your own home buying plan and help you on that path towards home ownership. Other than that, we appreciate you spending your Wednesday with us. I know there's other things you could be doing on a Wednesday night, but I appreciate you spending some time with us, and I really hope I get a chance to get connected with you soon. Have a good night. I'm still online, Mia, so I'll answer this question. Actually, I'll just go ahead and type this question to you.